It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast on another weekend. Yes, it has cruised into town. It's real estate we are talking about. It's property we are dreaming about with our non-stop suburb-by-suburb property information, breaking down the numbers and the trends every morning for the Australian real estate market. Looking forward to the weekend. Hope you are too. It's a Saturday morning, July the 5th. And good morning to you, Melissa. Thank you for taking the time to email us. You heard us talking with David Snell in Perth on Monday about parents who are buying homes for their children to rent out, as you say, mates rates to help them out. Now, you say that this is exactly what you and your husband have done for your daughter and son-in-law. Although you are in New South Wales, you've just exchanged contracts on an apartment in Mittagong for your daughter. You said that the Southern Highlands were unaffordable for her, so your only option was to buy something for them to rent from you. So we are now, you say, proud owners of our first investment property. Well done. And that really is a double upside for both you and your husband and your daughter. That's the up and up of that, isn't it? It's a win-win situation. And thank you so much for sharing that with us, Melissa. Do keep in touch. And remember, if you have got a property story, let us know what that is, whether it's a hardship story, whether it's something that you're finding a solution to. Our email address is myrealestatepodcast@gmail.com. Well, because it's a Saturday morning, let's bring in Anthony Landau, the Managing Director and Mortgage Broker at Equilibria Finance. And good morning to you, Anthony. You know, I have noticed in 2025, what Melissa has highlighted there, it seems to be happening more than ever with parents buying an investment property and then renting to save their children from falling on tough times.
Yeah, good morning, Craig. Great to be here again. And that's really interesting. And it is something that's happening more. And it just goes to the point of how difficult affordability, whether it's young people trying to buy a property or, in fact, even these days, just afford some of the rentals. And as we've seen over the last couple of years, even renting a property is becoming a challenge in some areas.
Yeah, no doubt about it. And this kind of segues us nicely because it is tax time again. And for many first-time investors, this will be their first experience navigating the end of the financial year as property owners. Melissa, you won't have to worry about this, of course, until the next financial year, but a lot to think about. Getting it right can make a real difference, not only in terms of compliance, but also when it comes to maximising deductions and minimising surprises. Anthony, when it comes to property investing, being smart at tax time is just as important as buying in the right location or securing the best loan. Being financially astute and aware really does matter in 2025.
Absolutely. Being tax smart with your investment property is incredibly important. And one of the reasons so many Australians invest in property is because of some of the potential tax benefits. There's about 2.2 million property investors in Australia, and a lot of them are mum and dads, self-employed income earners, and their investment property is part of their wealth accumulation strategy. Of those 2.2 million investors, about 1.3 million of these claim tax deductions on their investment properties due to negative gearing, meaning their rental income is less than their expenses. Getting it right, getting an operating rhythm with your investment property at tax time is really important.
Yeah, I like what you just said there, an operating rhythm, because that's what it's about, is getting into the groove. And one thing we often hear from accountants is that good record keeping can make or break your tax outcome. Talk us through just how crucial it is for investors to stay on top of documentation throughout the year, because a lot of us are lazy when it comes to good paperwork. Even I, if you can believe it, Anthony, I've been guilty of this.
Yeah, well, I can believe that. Sorry, mate. But yeah, look, good record keeping is really important. The reason being is you want to be able to track all of the income or the revenue that's generated, but as importantly is you want to track all the expenses associated with the running costs, any capital works, any interest repayments that relate to that specific investment property. In fact, some of the conversations we have with our clients when they're buying their property is to, for example, set up an offset account where the rental income gets paid into it and all the expenses associated with that property are run through that account. So you actually have a dedicated bank account to run your investment property through, and then you have your associated receipts and paperwork that will reconcile with that bank account at tax time that's nice and neat and clean, goes to your accountant, and everything related to that investment property, income and expenses, is nice and simply presented. And it's all there to maximise your tax time benefits of running an investment property.
You know, there's really no excuse for this because back in the day, we didn't have apps. All these devices that can make it so easy to track, and all you got to do is just make sure that you're putting it in day by day as it comes in. Apps have really revolutionised all of this to make it easier.
Yeah, they have. A lot of people now can take a photograph of a receipt, it uploads into their accountant's portal, and away you go. So getting it set up, particularly for a first-time investor, getting it set up at the start makes it really clean and simple, and it also means that you're maximising any tax benefits you might be able to get. So yeah, apps have really made the process a lot easier for a lot of people.
So there you go. Don't do what I have done in the past, although I'm not doing it at the moment. It was some years ago, but I had to sort of change the way that I was looking at investment properties. All right, we are talking to Anthony Landau on our Saturday morning. When we come back, we are going to look at rental income for a first-time investor. And also, on the other side of the ledger, we're going to look at the deductions. So that is next.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
You are in Bulimba in Brisbane. Boy, this area, it has really started to take off. So for those people around the country, they don't know where Bulimba is. They know nothing. Cue them in a little bit in terms of your suburb, your postcode.
I like to describe Bulimba as a bit of an island. We have water that wraps around 3/4 of it, and it makes us very isolated from the rest of Brisbane in the fact that there's sort of one way in, one way out. So it's a really nice suburb that's very relaxed, and it's got lots of nice community, nice cafes, restaurants, and it's very close to the city and also can get to the airport on the highway to the beaches very easily. So it's a lovely place to live.
You're listening to the Saturday Property Market Update.
Hey, the weekend is here, another Saturday morning, and with me is Anthony Landau. We're having a look at maybe some of the laziness of bookkeeping. Anthony, we're going to look at rental income for a first-time investor. It's important to know exactly what needs to be declared at the ATO, not just the rent collected, but any other associated earnings. So what should people be aware of here?
Yeah, the income side of it's fairly straightforward. You've got your rental income. A lot of that is either through long-term tenancy, you might have a property manager, or you might in fact be managing the property yourself. But if you're managing it yourself or using a property manager, get a lease in place. When the lease term comes up, get the lease renewed and make sure you can track the income being paid into your bank account week to week or month to month or whatever the payment terms are. This is for a long-term tenancy, or what's become a lot more popular in recent years is even with Airbnb and short-term stays. All of that income as well is declared because fundamentally it is an investment property. So whether it's long-term tenants or an Airbnb short-term stays, just make it nice and simple with a good strong lease to track your income.
You know, Airbnb, I don't know too much about just how heavy the paperwork is on that. I have heard people complain in the past. Is that a bit of an issue where, you know, if you're going to get laziness, it's something like an Airbnb?
Yeah, the thing with an Airbnb is you got a lot more traffic coming through. You might have short-term stays of 2 days. You might have short-term stays of 2 weeks. And for a lot of them, it's getting a system set up right from the get-go to manage all of that, because a lot of it can just be online where you then just get a monthly report on all of the activity through the property. Most people use a property manager for an Airbnb to look after and administer all of that, but Airbnb has a little bit more activity relating to the income side of it because you actually have more tenants over the course of a year.
I just feel that people that own Airbnbs that are not looking after all of that paperwork have just said to themselves, yep, that is me. I've been snapped out. Now, on the other side of the ledger, let's look at deductions. This is where investors can really benefit if they know what's allowed. What are some of the key items investors should be looking to claim, and where do people often miss some of these items out?
Yeah, it's really important to separate anything related to your investment property, any expense related to your investment property and your day-to-day living or your home. For example, some of the claimable deductions is the interest repayments that you make on a loan you might get, the management costs of the property agent fees, commission, maintenance costs, including cleaning, gardening, pest control and repairs. I mentioned before we often get an offset account set up with our investor clients to run their property through. They often get a debit card with that, so quite simply, they can pay the gardener or the pest control or any repairs through that debit card, so it's all nice and obvious and simple in that same offset account they're running their property through. Insurances can be claimed, landlord insurance, building insurance, contents insurance relating to that property. Body corporate fees can be claimed. There's land tax, depreciation, building costs, whether it's an extension or an alteration. In fact, you can even claim loan establishment fees and title search fees. Really make sure you understand what you can claim. An area that sometimes falls down that isn't properly understood is investment property depreciation, and getting set up from the get-go with a depreciation schedule, which essentially sets the framework for any depreciation or any capital works that you do throughout the life of the investment property. So something we talk to our clients from the start is talk to your accountant about getting a depreciation schedule when you purchase that investment property, because that over time will make it simpler to file your tax returns and track your capital works and the depreciation or the appreciation of the property over time.
Well, here we go again. Next week, the RBA, they've got that meeting coming up. What do you say? Here's prediction time, 25 or 50 basis points. What say you?
Look, I think they'll go 25 basis points. I think it's fairly clear we're on track for another deduction. It is arguable to take it to 50 basis points just to get the job done, but I think they'll take a cautious approach and go 25 basis points.
I'm going to be a little bit outrageous and go 50 basis points this morning. I've just got this feeling that they might just do it.
Well, let's shake hands on that and we'll see who wins, and they can buy the next coffee.
Done. All right. Well, enjoy your Saturday. Enjoy your weekend, Anthony. Good stuff. Look forward to chatting again soon.
We'll catch up again soon. Thanks very much.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
In 82.9% of Perth suburbs, buying is cheaper than renting. Sydney, Melbourne and Adelaide offer the toughest conditions. In every suburb analysed, renting is cheaper than paying off a mortgage. Brisbane isn't far behind, with 94.6% of its suburbs also favouring renters over buyers. I was really surprised about Perth.
Yeah, well, Perth surprises me, but look, it doesn't surprise me that much here in Melbourne, especially when you've got rents increasing at the rate they have been increasing over the last 5 years. And obviously with interest rates coming down, it's just bridging that gap between your rental repayments and your mortgage repayments. So more than ever, we're seeing first home buyers, and especially those who continue to rent, move into buying a home now.
We connect you to the best real estate information across Australia. The Real Estate Podcast.